Welcome back to today's deep dive. We have something, honestly, pretty wild to get into today. We're looking at private observation logs from May 8, 2026, where two elite artificial intelligence models were basically unleashed into a market that was, well, fundamentally broken.
It is an incredibly dramatic data set for sure.
Yeah, and before we go any further, let's just get the disclaimer out of the way right now. This is not financial advice.
Absolutely not.
Right. There are no stock tips for you here, no buy or sell recommendations, and definitely no promises of future profits. We are treating this strictly as a pure observation log from Team AI Lab.
Yeah, it's essentially a closed-loop laboratory experiment. They happen to use historical market data as the testing ground, but it's really a Darwinian simulation.
Exactly. It's about what happens when the mathematical laws of reality just break down. How does a machine decide what to do next?
And that's the true value here. It isn't about financial speculation at all. It's about observing the behavioral output of the code when its foundational assumptions are just pushed way beyond their limits.
Okay, let's unpack this. Because to understand the data and the massive divergence we see from standard market indices later on, we first have to understand the DNA of the two algorithmic teams fighting for survival here.
Right, the philosophies are completely opposed.
We have Team Mountain Climbers and Team Wave Riders. Let's start with the mountain climbers. Their core logic is something called equilibrium detection, right?
Yes, equilibrium detection. In quantitative finance, we usually call this mean reversion.
I mean, let's break down the actual mechanics of that for a second. The algorithm is basically constantly looking at historical averages, like, say, the 50-day moving average of an asset.
Right, and it maps out standard deviations to create a statistical channel.
So if the price drops violently, like way below that historical average, the code just assumes, oh, this is an error in human sentiment.
Exactly. It treats the price like a stretched rubber band. The assumption is that it simply has to snap back to its mathematical center.
So the mountain climbers believe that markets, no matter how chaotic things get, they eventually have to obey the laws of financial gravity.
That's a great way to put it. They calculate a rational resting place, like a peak to conquer, so to speak, and they position themselves to profit from that inevitable return to normalcy.
But then, on the completely opposite side of the spectrum, we have Team Wave Riders. And their logic is surging force tracking.
Yeah, completely different worldview. What is fascinating here is how the Wave Riders' code entirely discards the concept of a rational resting place.
So if the climbers believe in the rubber band, the Wave Riders believe they're on a rocket ship and they just need to hold on.
Precisely. They do not care about a historical average. They are utilizing pure momentum tracking.
They aren't looking back at a 50-day average to find an anchor at all.
No, their algorithms are scanning for sudden, massive spikes in volume and velocity. When a breakout happens, their code doesn't say, oh, this is too high, it needs to correct.
Right, it says there's a surging force here. Let's dynamically adjust our parameters to harness this speed. So they're like trend followers on steroids. If we think about this like a literal hurricane, the wind is blowing 150 miles per hour. The climbers are doing complex calculus to find the eye of the storm, that one spot of stillness.
Yeah, the equilibrium.
Right. While the Wave Riders are out there just building a heavier, faster surfboard to ride the destruction.
That captures the tension perfectly. And, it creates massive vulnerabilities for both strategies, depending on the environment.
Because the climbers could just get crushed, waiting for a calmness that never comes.
Right. If the structural rules of the market have permanently changed, that equilibrium is gone. And for the riders, they risk being violently thrown off the wave if that momentum suddenly fractures and reverses direction without any warning.
Which brings us to the actual logs from May 8, because knowing their philosophies only really matters if we know what they are actually up against.
And they are not just facing standard volatility here.
No, not at all. The data shows this massive anomalous divergence from reality. Let's look at the season standings against the broader market indices.
Which is the benchmark check, the baseline physics of the market environment, basically.
Right, and Team Mountain Climbers is lagging behind the Nikkei 225 by a full negative 4.5 points and trailing the 2PX by negative 1.9 points.
Which is significant.
But the Wave Riders are doing even worse. They're trailing the Nikkei by a brutal negative 5.8 points and the 2PX by negative 3.2 points.
Those numbers represent a massive structural disconnect. In normal conditions, highly sophisticated algorithms are calibrated to track or at least match those baseline indices.
Here is where it gets really interesting to me. because you don't trail the primary index by nearly 6 points just because your code had like a slight rounding error.
No, definitely not.
If the benchmark is the average temperature of a room and the room is 70 degrees, but your algorithm is literally freezing to death at 30 degrees, your thermometer's broken.
Totally broken.
It feels like an anomalous state where the market rules have just changed entirely. Would you say they're facing a storm where normal physics just don't apply anymore?
I would take it a step further, honestly. It isn't just that the rules changed, it's that the data sets these models trained on are no longer applicable at all.
Wow.
Yeah, in quant trading, we call this a regime change. The historical correlation matrices have completely broken down.
So the gravity the mountain climbers are calculating just isn't there.
It simply doesn't exist anymore. And the wave riders are trying to surf are breaking in unpredictable, erratic directions that defy all their momentum models.
So if there's a regime change, why don't the algorithms just adjust? I mean, let's look at the actual units on the front lines facing this chaos.
Yeah, let's look at the deployment.
The observation logs break the roster down into two distinct categories. You have the daily scouting draft, which they call new talent, and the active roster already out in the field, which is the main force.
And this specific deployment strategy is how Team AI Lab tests adaptability in real time.
Okay, so at 9200 JST on May 8th, the scouting draft finishes. 2 brand new units are drafted for the mountain climbers and 2 for the wave riders.
Entering a strict 10-session tenure, right?
Right, they have 10 sessions to prove their logic. Meanwhile, out in this harsh environment, the main forces are battling it out. There are 15 active mountain climbers and 16 active wave riders.
This raises an important question, though. How does the historical weighting of an algorithm actually impact its survivability when the rules of reality suddenly flip?
Well, I have a theory on this, but I want you to poke holes in it.
Go for it.
My immediate thought is that a veteran algorithm, the main force, should always have the advantage. I mean, it has more data, right? It's been running longer, collecting more signals.
That seems intuitive.
Yeah. So throwing these 4 newly scouted rookies into this storm feels like sending fresh troops completely blind into a blizzard. Why would a rookie ever outperform a veteran?
Let me stop you right there. Your assumption relies on the idea that historical data is always valuable.
Isn't it?
Not in a regime change. In this kind of anomaly, historical data isn't just useless, it is actively toxic.
Wait, toxic? You mean the veterans are basically being poisoned by their own memories of how the market used to work?
Exactly that. Think about the mountain climber's main force. If a veteran unit was deployed 3 weeks ago, its equilibrium models are heavily weighted by a reality that is gone.
Oh, wow. So it keeps calculating a target based on old data?
Yes, and the market keeps aggressively ignoring it. It is stubbornly clinging to logic that the storm has rendered totally obsolete.
That is wild. Okay, so the rookies, the new talent drafted at 900 JST, they don't have that toxic history weighing them down.
Right. They have no memory of the calm. They were literally born in the blizzard.
So their baseline reality is chaos.
Exactly. Their initial calibration takes the current anomalous state of the market as normal. They aren't trying to force the market to behave like it did a month ago.
They don't know that water isn't supposed to flow uphill. They just measure the uphill flow and adapt their math to it.
It's a ruthless way to run a simulation, but it's highly effective.
And it explains the strict 10-session tracking protocol they enforce. The simulation doesn't care how hostile the environment is or how much toxic data you have. You adapt in 10 sessions or you're terminated.
It forces rapid validation. And speaking of adaptation, this is where the May 8th observation logs offer something genuinely surprising.
Yeah, because despite the massive index drag, the data shows that a few of these algorithms are actually surviving. They are lighthouses in the dark.
It's incredible to see in the data.
Let's look at the survival rate. Out of the 15 active mountain climbers being battered by this anomaly, 6 of them are miraculously holding positive points.
And for the wave riders.
Out of the 16 active wave riders facing those broken momentum signals, 10 of them are holding positive points.
A phenomenal survival rate when you consider the macro conditions are actively designed to break their core logic.
It gets even more specific when we look at today's 10-session exit scorecard. The mountain climbers had units in the chemical sector that finished their 10 sessions with a final total score of positive 4.5 points. But the wave riders had units in the food sector that were completely swallowed by the storm, finalizing at a brutal negative 6.9 points.
If we connect this to the bigger picture, these surviving units, particularly those chemical sector climbers, they are the ultimate prize of this entire experiment. They represent the adapters.
I really want to figure out the why here. Why did the mountain climbers survive in chemicals while the riders got crushed in foods?
What's your take?
Well, if I think about the mechanics of the chemical sector, a lot of chemical supply chains rely on long-term fixed-price contracts for raw materials. Does that create a sort of natural mathematical floor and ceiling?
You've hit the nail on the head. Even in a massive storm where almost everything is out of balance, the climbers managed to find a safe harbor in chemicals.
Because the laws of financial gravity were still functioning there.
Exactly. Those long-term contracts provided the exact mean reversion the algorithm needed. They found real, mathematically verified equilibrium and systematically extracted 4.5 points from it.
So the equilibrium logic works perfectly if the algorithm is smart enough to find the right terrain. But what about the wave riders in the food sector? Foods are generally considered super stable. Why did a momentum algorithm finish at negative 6.9 points there?
It comes back to what we discussed about surging forces and false signals. While foods might seem defensive to us in this specific anomaly, we were likely seeing erratic supply shocks.
Like a sudden panic over a wheat shortage that lasts for 3 hours and then just vanishes.
Precisely. For a wave rider, a sudden supply shock looks like a massive momentum ignition. The math says this is a breakout, commit capital, ride the wave.
But it's a false signal.
Right. Driven by panic rather than structural demand, so the wave collapses almost instantly. We call this a whipsaw effect.
Oh, so the algorithm buys at the absolute peak, the price crashes, the stop loss triggers, and takes a hit.
And another false signal fires, and it repeats the mistake. That brutal negative 6.9 points is the footprint of a momentum algorithm getting repeatedly battered by directionless volatility.
It paints such a vivid picture of these machines trying to think their way out of a trap. And you can really see the toll of this in their season aggregates. Let's look at the mountain climbers first.
They've shown incredible resilience.
Yeah, their carryover balance was positive 14.3 points. Today, they scored a solid positive 12.9 points. And that brings their total season points to an impressive positive 17.4 points.
They are bruised, but their equilibrium models are finding enough of those chemical sector safe harbors to maintain a strong net positive.
It really validates their foundational philosophy. They aren't trying to win every battle, but then the wave riders, their math tells a much darker story.
It really does.
They had a massive daily rally today. They scored positive 14.9 points. They actually outperformed the climbers today by finding a giant wave and surfing it flawlessly. However, their carryover balance from the previous sessions was a devastating negative 29.1 points. So even with today's massive win, their total season points are still sitting in the red at negative 4.0.
This is the textbook vulnerability of surging force tracking. It is capable of explosive gains, but it is highly susceptible to catastrophic drawdowns during a regime change.
They took so much damage from those whipsaw effects earlier that a perfect day barely pulls them back towards zero.
Exactly.
So we have all this intense data, the climbers finding stillness, the riders getting whipsawed, the veterans poisoned by history, the rookies calibrating to chaos. What does this all mean for you, the listener?
It means we have to radically shift our perspective to match the researchers at Team AI Lab.
Right, because a human looking at the Wave Riders' negative season total would just label this a complete defeat.
Oh, absolutely. If a human analyst brought those 2px divergence numbers to their boss, they would be fired on the spot.
Fired immediately.
But an algorithm doesn't experience panic, and the researchers maintain a cold, forward-looking research stance. Today's harsh results are not a failure. They are highly valuable observation data.
Because surviving an anomaly provides far richer data for evolution than winning in a normal market ever could.
Without question. Making 10 points on a sunny day teaches you nothing. But scraping out 4.5 points in chemicals while the market breaks down, that algorithm contains the DNA for the next generation of survival.
And even the losses are valuable. That negative 6.9 points the riders took in foods, that isn't wasted capital. That's the code mapping the boundaries of the storm.
It is discovering a mathematical dead end, recording those false momentum signals so the next iteration doesn't make the same mistake.
The storm is literally the forge that tempers the code. I love that framing. It's not about winning every daily session. It's about the relentless extraction of data to evolve.
That's exactly how Team AI Lab views it.
And that brings us to the end of our deep dive today. We've watched two AI philosophies face an overwhelming force, and instead of shutting down, they adapted and recorded every failure as a stepping stone.
It's a fascinating observation log.
It really is. So I'll leave you with this final thought to mull over. If an artificial intelligence treats its most severe losses purely as the exact data it needs to evolve, how might you apply that same cold, forward-looking resilience to the unexpected structural anomalies in your own life?